Hi, my name is Jesse Durham, and today's subject is going to be whether we should save money or practice the infinite banking concept. So let's start with, if we do not have already the discipline or the habit or the practice of setting aside money somewhere for something, do we or do we not set aside a portion of what we earn, whether that's as an employee in a small business, in a side hustle, in a big business, in investing? Do we or do we not have the practice of setting some money aside somewhere? Now, if we don't, I would question that. That there's always a starting point to something, and you eat an elephant one bite at a time. So in the event that you, like me at one point in life, haven't gotten to a place where something is set aside with purpose, with intentionality, then just consider maybe why you would want to do that and answer that for yourself. The rest of this video, I believe, would be helpful for those that are already practicing setting some money aside for various reasons, but also for those who haven't yet started. I was there once, so stay along with us here and let's see why. The who's, the what's, and the whens, and the where's. And that's where I'll start with next. So if you're already setting aside funds somewhere, let's start asking ourselves some questions. Who for? I don't mean that sarcastically. I'm really asking us to consider, who do we set our money aside for? And of course, you're naturally going to be saying, well, I set it aside for myself. Obviously, Jesse. Well, okay. All right. So let's keep answering these next questions and then actually see if that is true. So if you're actively set asiding and have the practice of setting aside money for yourself, okay, let's start asking now, when? I mean, how often do you do that? And there's not necessarily a right or a wrong here. I know that we may earn along different time schedules. Some, that are employed will be paid monthly, biweekly, weekly, whatever the case may be. But also the businesses may have highs and lows, ups and downs, in seasons, out of seasons, etc. Investments, maybe some of you are making short-term investments, long-term investments. Regardless, just having that question answered of, when do I set aside money? When am I making savings? It's just good to be aware of. Check it, adapt, make any changes as you deem fit. Next, let's consider where. This is going to be an important one, obviously, for those of us that have already seen some information here or have read R. Nelson Nash's book, Becoming Your Own Banker, and his second book titled Building Your Warehouse of Wealth. So that warehouse idea, where is it that we are putting our money? See, for some of us, that could be under our mattress. For some of us, that could be in a checking or a savings account at a commercial bank. For the clients and myself and others that are already practicing the infinite banking concept, it could be through whole life policies that have been properly structured for the banking purpose, wherein we're with mutual companies, so we're part owners, and we actually anticipate dividends as well. So that would be our warehouse. So regardless of where you say you put money, and I'm not here to tell you where to, but I'll throw out some ideas. I'll put out some questions that should give us thought. The next question to where would be, who owns that entity? I mean, where is it that we're putting money, and who does that really put it in the control of? And that might be me getting a little bit ahead of my notes, but that is a question, and it's a valid one. Where do we put our savings? Where do we put our money? Any surplus, etc. Any funds at all. The next question could be, why? Why is it that we are saving? And again, that's for you to answer. I know that in having, worked with clients, and then for myself, we've had discussions where there's a vehicle to get paid off. Okay, so we're setting aside money, or a vehicle to purchase. Okay, it could be a piece of business equipment. Maybe you're buying something, building something, developing something for your business. Maybe you're setting aside money for a business deal that you want to have in the works or anticipate having in the works. Maybe, it's something for your household. Just anything could fit that space, but I'm just, again, asking the question here to get us to think, what is it that we're saving for? Now, if we're specifically saying that we're setting aside savings, well, my question is, what do you mean by that? What does that mean to you when you say, I'm setting aside savings? We have these sayings of, save now for a rainy day. Some people would even call a savings account a rainy day fund. But you should be able to answer that for yourself and really know what that actually means for you by looking at these who's and what's and when's and where's. Who are you setting that money aside for? Who are you saving it up for? When are you doing it? How often, for example? Where's it going? Who owns that entity is going to be my follow-up question there. What for? Why? How? So when we start to answer these questions, let's take the example of under the mattress. Now, when we put that money there, is it a discipline and a good discipline? Sure. If you deem that it's a good discipline to set the money aside, fantastic. I agree. In doing so, we're accomplishing certain tasks, right? It's a liquid form. It's accessible. We could go and we could get that money when the anticipated use of it arises, okay? Or in the event of an emergency or just some unforeseen need, okay? I agree that the foresight and the preparation and the planning of setting money aside has great value, to be sure. But there are also some inherent risks there. It's liable to theft. That's actually one of R. Nelson Nash's principles from his book, Becoming Your Own Banker, is the Willie Sutton law, is that there are always going to be people who would legally or illegally try and separate our money from us. So it could be stolen there. It could be burned. It's just there are different things that are also happening there in that particular situation. So let's contrast that. Let's say you are actively setting aside savings in a qualified plan, a 401k, an IRA, even if it were not an investment vehicle of any sort, even if it were a savings account or a special checking account that you have set aside for those particular savings funds. Again, it's probably more liquid in the checking account and savings account scenario. We could go by the bank or maybe use online banking to access those funds for an emergency or for some anticipated need, either one. Perhaps less accessibility, obviously, due to taxes, penalties, fees with qualified plans, the 401ks, the IRAs, etc. And so there are different levels of accessibility there, control, terms, all of which is mostly out of our hands. And then the crux of what I would like to focus on in that particular example is we are allowing the owner of that entity to access our funds for their use. There's very much a set it and forget it mentality for many in the investment world. And I'm not here to say that the infinite banking concept is an investment. We'll get to that. The infinite banking concept is just us providing for our own need for finance. It's just us not abdicating the banking function to someone else, but maintaining it to our own purposes and our own ends and at our own direction and discretion. So in recognizing then that we are giving our capital over to someone else by setting it and forgetting it to use for their purposes, sure, there'll be some pittance for us, along the way. We, with a checking account or savings account in commercial banks today, obviously there's not a lot going on right there. CDs, it's not what it has been before. But again, I'm not necessarily trying to focus on returns on any investments. Yet, it's worth looking at. We should consider the returns that we can expect on what we do with our money, but I'm trying to focus for the moment on the banking function. If we're setting aside funds for a year, 5 years, 20 years, 30 years, with the expected end that there's going to be our capital there plus, interest, gains, profits. It will grow. That's the expectation. But I would naturally question, well, what are the guarantees of that happening? But not even just that, but along the way, over those years, do we or do we not have access to those funds for the here and now? See, what I would promote is the idea that by becoming our own banker, by practicing the infinite banking concept as described in R. Nelson Nash's book, that we could both have an expected and even a guaranteed end. I mean, when we own a whole life policy that's been properly structured for this banking purpose. It's going to be with should be with a mutual company that is, paying consecutive dividends for well over 100 years. It should be a known outcome. We should have a known and a contractual, and we would have. It's a unilateral contract. We would have known cash values. We would have known death benefit because of that policy, in owning that policy, which also means, therefore, then that we would have contractual rights to access those funds immediately. And then, of course, over the span of the existence of that policy. So the banking function cannot be overlooked. How can we accomplish more than one task with the same dollars? How can we? Because I'm not trying to say that IBC or savings are mutually exclusive. Can you put money in a checking account or a savings account or a 401k or an IRA or some qualified program or even that hole in the ground or under the mattress or in the coffee can? Can we do that and buy a whole life policy that we own and control that would give us a guaranteed death benefit but also guaranteed access to the cash values in our policy? Can we do both of those? No. But could we own said policy and also use the cash values in that policy that's been properly constructed for our purposes with the guaranteed growth, with everything that's been outlined here and in other content on our channel, of course, and have those funds accessible for savings? Whether that's saving up for something that we're going to consume, something that we're going to purchase, or in the event of an emergency. Yes, in that scenario we can. So in one we cannot, in one we can. I'm just a big proponent of accomplishing more than one task with the same literal dollars. So when we answer that question of what do we mean when we say we're setting aside money for savings or in savings, why then would folks such as Robert Kiyosaki infamously or famously say that savers are losers? Now let me time out here. Let me pause and say, let's not get caught up in the negativity or the being offended. Let's not be defensive about that title. He is a best-selling author. Emphasis on selling. Sure, he's a great business mind, but again, he is in the business of business, and he's a bestseller in personal finance. Has been for years and years. Why would he then say savers are losers? And I think that the crux of it, when we look at that saying through the lens of the infinite banking concept, would be that in the event of traditionally setting aside money somewhere where someone else is the owner of that entity, someone else sets the terms, conditions, whether we can or cannot, and how we can access those funds, the yield that it may or may not lead to, all of that, abdicating our ability to control and to dictate and to use according to how we want, abdicating that banking function, as we would say here, to someone else for someone else's benefit. We're supposed to set it and forget it. So that's why I believe that Robert Kiyosaki, for example, would say that savers are losers. So again, if we can get past, he's trying to provoke us, obviously, and hopefully it's to thought. Hopefully it's not to anger. Hopefully it's not to immediately disregarding the sentiment and the thinking behind the idea that savers could be losers, but cause us rather to look at how we would respond to that saying. So do with that what you will, but let's consider that. And then let's combine that with what R. Nelson Nash has said. Another one of his key principles in his Becoming Your Own Banker book is he who has the gold makes the rules. It's the golden rule. So again, that's the benefit, right, of having money under the mattresses. Is when I want to go under the mattress and get my money out, I can, or a checking account or savings account, I could go to the bank. There could be an interjection right there about historically, there having been runs on the banks, etc. And How that's contrasted with these whole life companies that have been in business for well over 100 years, paying a dividend consecutively for well over 100 years. I personally own a policy contract where one of the companies, and I'm not married to any one particular company, I own multiple policies with multiple companies, but right off the top of my head, one particular company, 140 years consecutively paying a dividend. That's through recessions, depressions, world wars, pandemics, government shutdowns, etc. Okay, so in combining what Kiyosaki has said in savers are losers, and recognizing what Nash has said, which is an undeniable principle that he who has the gold makes the rules, it causes us to look at the banking function in our lives. So is setting aside money in savings essentially putting money in a hole in the ground? Could we not at least, as a household, finance or consider what would it look like if we financed our activity as a household? Now, if you're a business owner, what would it look like if you financed the banking function in your business? And Rome wasn't built in a day. You eat an elephant one bite at a time. You do this brick by brick, block by block, piece by piece. Even Nash would say that it may take the average American 14 years to end up becoming completely financially independent, meaning that they could account for the entire banking function for their household or for their business. Okay, and it may be happening quicker or longer. That's up to us. And yet, let's see that if we can accomplish more than one task with the same dollars, if we're not just setting aside money that we're not supposed to touch, and it's our money, if we're not setting aside money that we're not allowed to touch without penalties or fees and whatever that may end up looking like, depending on where we've put it, what if we could accomplish the task of maintaining control of the banking function to create an appreciating asset, such as, insert here, a whole life policy that's been properly structured, and also have access to savings funds or emergency funds or rainy day fund? What if we could do both at the same time? Cash is king. Now, in considering that statement, I would like to also consider there's a parable in the Bible where there was a man who buried some money. Okay, and we won't go too deep. I actually would like to do that for a future episode, but there was a man who buried money. Now, what I will use at this moment is the concept that buried money does not earn. Now, that's not to say that you couldn't put something aside somewhere and have it appreciate over time. Are there antique cars, big, fast, tough, cool muscle cars that appreciate with the proper care and whatnot over time? Sure. If you're putting precious metals in a hole in the ground, is it possible that they could appreciate over time? Sure. That's not what I'm talking about. What I'm talking about here is the banking function on those funds, because if we can agree that money is simply a means of exchange, meaning that we would pay money for groceries, but also we could sell groceries for money, or that we would buy a car with money, but also there are folks who sell cars for money. If money is just a means of exchange, how much exchanging is taking place? How much growing, profiting, gaining is taking place in the hole in the ground? So again, if we could do both, if we could both have an entity that we own, wherein we have guaranteed growth for the long range, and we're talking about, policies of up to 121 years, but also that come with contractual rights to access that cash value in that policy in a known interest environment. Okay? With me saying this all while the government is literally printing money. But let's not go down that rabbit hole too soon. If we could accomplish more than one task with the same dollars, that's a win-win scenario. So are we putting our money essentially in a hole in the ground somewhere where we cannot earn it, where we can't access it, where it's not profitable to us, all while we have this need of finance in our households, in our business, in our investing. There's always, see, that was the whole crux of Becoming Your Own Banker, the book. What Nelson would say was that our need for finance far outweighs our need for a death benefit. That's not to disregard a death benefit, because we get cash values according to death benefit. The cash value is just a net representation today of the anticipated death benefit somewhere along the line, okay, when we graduate. So having the access now for our use, for our need for finance, can be accomplished with the infinite banking concept, all while having savings, if that's what we want to have, is an emergency fund set aside as well. Let me break down quickly, again, a simplified version comparison between setting aside money in a savings account. Because with a savings account, you traditionally receive more of an interest rate, let's say, than with a checking account. But again, it could be anything here, okay? We could still make any comparison, because again, I'm not trying to disregard any investment. If you want to invest in something, invest in that thing. But can you maintain control of the banking function and do that investment at the same time? Yes, with the infinite banking concept. You could do both. But it can't be the reverse. You can't make that investment, any particular investment, and also have the same kind of, access and control and favorable terms and whatnot to then get whole life policies. All right, so let's look at this scenario, because it's all about the banking function. Who's performing the banking function, okay? If we start with the banking function, if we start with our need for finance, we can do everything else imaginable from there. Okay, let me get back to my comparison. Okay, so here's our comparison. Money is set aside in a hole in the ground, in a mason jar, in a savings account, in a checking account for a rainy day. There's that, and it's there. Maybe it earns some pittance of interest with a commercial bank if it's in a hole in the ground or under the mattress or in a mason jar. No, it doesn't. But it's accessible, it's liquid, and it doesn't matter whether it's big or small. Let's just make the comparison. On the other hand, if you had a policy that you owned, a whole life policy with a mutual company that paid a dividend, you would have guaranteed growth in your cash values and your death benefit. And of course, here we would promote the idea that, in general, of course, you're going to want to grow and to scale what it is that you're doing to have your dividends by additional paid up insurance. So your cash values and your death benefit will grow daily. On weekends, on holidays, it's going to grow daily. So there's that inherent growth in your unilateral contract. Also, if we're actively practicing the infinite banking concept, the rules are pay yourself first, pay yourself with interest, and recapture the money. Well, that second rule of pay yourself with interest means that we're going to be actively scaling what it is that we're doing, adding interest to what it is that we're already doing. Because again, if we were to borrow money elsewhere, we would pay interest there. So we would treat ourselves the exact same way, just like a bank would. This is our bank, and we would pay interest. So there's going to be that growth of ability and capability within our financial footprint, because we are paying that interest to ourselves now, not to someone else. And then thirdly, and perhaps most importantly, what we do with the cash values in our policy can dictate real returns that we would otherwise see. See, it doesn't matter whether you're doing real estate investing. It doesn't matter whether you're building and scaling a business. If you're running a household, whatever the case may be, whatever it is that you would actively do with your money to earn, you would still do with your cash values from your policies. So again, two birds with one stone. Not putting the money in a hole in the ground where it's not going to accomplish anything, but at the very least, banking with our own money. Remember, becoming your own banker is bringing banking back to the me and the you level. Now let's cover some key concepts to the infinite banking concept by asking some questions, because these are questions that I commonly hear. In fact, I was on the phone today and the subject of capitalization came up. Capitalizing a policy, paying in the beginning and not having access to 100% of the premium dollars that we pay. That's the capitalization phase, and there's not. What I would like to point out quickly is that there is no loss of value in the beginning of a policy. There is a loss of liquidity in the beginning, meaning that we cannot access 100% of the value of this policy, of this entity that we own. And obviously that grows. I mean, you see that in your contract. It grows day after day, year after year, guaranteed contractually, unilateral contract. And yet the issue of capitalizing, of paying premiums comes up, and folks will ask, well, do I have to do that? My answer is no. You could go capitalize someone else's system. You could completely abdicate the banking function. And I'm not trying to be facetious. I'm trying to compare what I've done in years prior to practicing the infinite banking concept. When I needed to buy a car, I would borrow someone else's money to pay them interest back for that depreciating liability that I would buy. Okay, so did I have to capitalize my own system? No, I did not. And no, you do not. But should you? That's up for you to answer. The next one would be, do I have to keep paying this premium? When we talk about the structure of a policy, do we have to keep paying premium after year 7, year 10, year 30? No. But I would ask the question in return, how long do you anticipate using money? Because our need for finance is not going to go down in the future. Our need to access our capital is not going to go down in the future. So why would we ever set ourselves up? And again, we take everything here on a case-by-case basis. But as a principle, I'm not expecting to have less capital in the future. I'm not expecting to have access to less capital in the future. And I wouldn't suggest that you do either. Jesse, do I have to repay my loan? How about that one? No, you could steal from yourself. You could be a thief. That's not me being facetious. That's right from Nash's book. He gives this grocery store example where he talks about, would the owner grab a can of peas off the shelf and walk out the back door? It's tempting, but that's the work of a thief. So again, I would never suggest that you not have a plan to pay back policy loans that you take from your policy. Now, I've made every mistake that's possible. That also is one of the mistakes that I've made along the way in becoming my own banker over these past several years, was not having in place a plan to strategically pay myself back, pay that policy loan back, and with interest. And that's the next part is, Jesse, do I have to pay interest, to access the cash values in my policy? Do I have to pay interest on that policy loan? And to that, I would say, no. You're the banker. You get to choose. But why would you devalue your money? See, when we borrow money anywhere else, third-party lenders, commercial banks, we're going to borrow their capital, their principal, and pay back interest. So again, this is bringing banking back to the me and you level. This is becoming your own banker. Pay yourself with interest. Don't devalue yourself. So I hope that this has been very helpful in deciding what your savings situation looks like currently, what your banking situation looks like currently if you're already a client, of course, how we can accomplish both the banking function and savings, having access for emergency funds or for anticipated consumption, something that we're going to be purchasing. But if you have any further questions, don't hesitate to comment in this video. Don't hesitate to reach out. You can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. This has been an absolute pleasure for me. I look forward to our next conversation. Have a great day. Take care.